This is a uh, review of inventory, in particular inventory weighted average valuation. And the one thing I should mention right away is that weighted average valuation is associated with periodic inventory systems. So let's take a look at how we use weighted average inventory valuation in a periodic inventory system. And the calculation is actually fairly simple. And here it is right here. It's our beginning inventory, the value of the beginning inventory, plus our purchases during the accounting period, the total of those two, divided by the number of units in our beginning inventory, plus the number of inventory units that we purchased during the accounting period. We divide the value of the inventory by the units in inventory, and that is going to equal our weighted average cost per unit. We're going to take that weighted average cost per unit, then apply it to the remaining units sitting in our inventory, which would be our ending inventory, and that's what we're going to use to value our ending inventory. The best way to explain this is to go through a relatively simple example. So let's take a look at XYX Company. Now XYX Company had 100 units in the beginning inventory balance, or with a beginning inventory balance of $2,000. During the year, it purchased 50 units of additional inventory for $1,060. Also, 110 units were sold during the year. So now the question is, what is the cost of goods sold for the year? Now, before we go on and look at the detailed calculations, let's just take a look at this inventory summary right here. And again, you can see that it is a classical periodic inventory formula. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. Or another way of saying it, beginning inventory plus purchases, that equals our total cost of goods available for sale during the accounting period. We then subtract out the inventory we haven't sold, which is our ending inventory, and the remainder would be our cost of goods sold. Now let's see how these inventory items were valued. First thing is beginning inventory. We said $2,000. Okay, now that's the inventory value from the previous ending inventory in the previous accounting period. So we don't really have to compute that because that was computed in the previous accounting period. And we're told here the company had 100 units in beginning inventory plus a balance of $2,000. So the beginning inventory balance is fairly simple and straightforward. Now what we need to do is we need to compute the weighted average cost per unit of our inventory. And again, what we're going to do is rely upon the formula right here at the top, and we're going to do the computation down here as the example. Okay, we start off with our beginning inventory. We said $2,000. To that, then, we add the total amount of inventory purchases for the period, $1,060. And we're going to take that quantity, then divide it by the beginning number of inventory units, which in this case was 100, plus the 50 additional units that we acquired during the accounting period. So it's going to be $3,060 divided by 150 units. That means we have a weighted average of $20.40 per unit when we value our inventory. So let's go ahead now and take a look at, again, we talked about our beginning inventory. Our purchases during the year, the value of our purchases was $1,060. But now we have to value this ending inventory. And the way we do that is we have to determine how many units were remaining on hand in the ending inventory. And according to our computation, we're saying there were 40 units on hand. The way we get that is we had 100 units to begin with. We purchased 50 units during the accounting year, which means we had 150 units and we had 110 units that were sold during the year. So it's 150 units beginning inventory plus our purchases minus 110 units that were sold. So the net of the two is 40 units that are in ending inventory. So if we take the 40 units on hand in ending inventory and we multiply them times the $20.40 weighted average per unit, it comes out to $816. So now our inventory value is equal to $816. So now we have our beginning inventory of $2,000 plus our purchases of $1,060. Again, that totals to total cost of goods available for sale in the accounting period. I'm sorry, I got the wrong. In the accounting period of $3,060. From that, we subtract the value of the inventory that wasn't sold of $816. So that means we have a cost of goods sold equal to $2,244. Okay, with this formula and process in mind, let's go ahead and take a look at question number 1. Number 1 is Helix Venture maintains a periodic inventory system and the company uses a weighted average costing. Now, what we have to remember is that weighted average costing is always used with periodic inventory systems. So we probably could have, if we just said weighted average costing and didn't say periodic inventory system, you'd have to still assume it's part of a periodic inventory system. So that's just a point. If the examiners decide to omit that first sentence, you could still work through it. And the question is, what is Helix Ventures cost of goods sold for year 2? So go ahead and consider your question and the answers and stop your video now. Okay, number 1. The answer to what is Helix Ventures cost of goods sold for year 2? It would be B, $128,000. So let's see how we do that calculation. Okay, it says here in year 2 the company had a beginning inventory balance of 5,000 units with a value of $20,000. So again, we're going to use our classic periodic inventory formula. Beginning inventory plus purchases equals total cost of goods available for sale minus ending inventory equals our cost of goods sold. So again, we say our beginning inventory is equal to $20,000 and that amount is inserted there. We also know that we said we'd purchase 15,000 more units for a total of $140,000. So we add that $140,000 as our total purchases during the accounting period. So our beginning inventory plus our total purchases equal cost of goods available for sale of $160,000. We take that $160,000 and we divide it by the quantity of our beginning inventory of 5,000 units plus the amount of purchases of 15,000 units. So it's going to be 160,000 units divided by 20,000 units, or our weighted average cost is going to be $8 a unit. Now we have to subtract out the ending inventory, and the way we arrive at the ending inventory value is we take the number of units on hand remaining in our inventory. And according to this question, it says the company conducted a physical inventory and verified 4,000 units were remaining on hand. So I take my 4,000 units that were remaining on hand times my weighted average cost of $8 per unit, and I end up with a valuation of $32,000. So the total cost of goods available for sale is $160,000 less the inventory I had left over. The ending inventory of $32,000 means I had a cost of goods sold value of $128,000. Okay, now let's take a look at number 2. And Montford Cattle Crossing uses a periodic inventory system, and the following are the inventory transactions for the accounting period. Down here in the next paragraph, Montford uses a weighted average pricing method to determine the value of its inventory. So what amount should Montfort report as a cost of goods sold on its income statement for the accounting period ended? Go ahead and work on your problem. Stop your video. Okay, number 2, again, Montfort uses the weighted average pricing method to determine the value of its inventory. What amount should Montfort report as cost of goods sold on its income statement for the accounting period ended? In this case, the answer is B, $37,500. So again, let's take a look at the inventory formula. And again, we're going to see, if we go at the bottom, there's our classical periodic inventory formula. Beginning inventories plus purchases minus an ending inventory equals cost of goods sold. At the top, we also have a reconciliation of the units in inventory. So let's take a look at the process. We're told that we have a beginning inventory of 10,000 units at $3 each. So we know our beginning inventory value is going to be $30,000, and we insert that right down here as beginning inventory, $30,000. We also post up here to this little unit calculation, we had a beginning inventory of 10,000. During the year, or during the accounting period, we purchased 5,000 units at $4 each and 5,000 units at $5 each. So when we take a look at our units, we don't care what dollar amounts they are, we just want to add our units. So to our beginning inventory, we add our 2 purchases. That would be the 10,000 units. We also then we also said we sold 10,000 units at $10 per unit. So in this case, we also show sales at 10,000. So we started out with 10, we purchased 10, and we sold 10,000, means the units in ending inventory equal 10,000. So that's going to be an important number when we decide to start valuing our ending inventory. So that gives us our ending units in ending inventory. Now let's take a look at our formula. We know we had a beginning inventory of $30,000. During the year, we had purchased $5,000 at $4 a unit, which is $20,000, and $5,000 at $5, which is $25,000. And we see then our total purchases for the year is equal to $45,000. Now, if we took the subtotal, that would be $75,000 would be our total cost of goods available for sale. Now we have to value our ending inventory. So again, we use our weighted average formula, our beginning inventory of $30,000 plus our $45,000 worth of purchases we computed. We're going to divide that quantity by the 10,000 units in our beginning inventory plus the 10,000 units, which is 5 and 5 of the units purchased during the accounting period. When we do that, it would be a matter of 75,000 divided by 20,000, and we come up to $3.75 weighted average cost per unit. Now we know how to value our units in ending inventory. And what we see is from our computation, we had 10,000 units in ending inventory. So 10,000 units times $3.75 equals $37,500. So in this case, the cost of goods sold would be equal to $37,500. It looks like an odd amount because of the ending inventory, but this just happens to calculate out this way. So that's the answer to question number 2, and that is the end of weighted average valuation for periodic inventories.